Hi, my name is Mike Resnick, and I'm a tax associate at Eversheds Sutherland. With me today is a tax partner at the firm, Ellen McElroy, and we're happy to discuss with you the implications of tax reform on income recognition.
Mike, as you know, the recent Tax Reform Act made sweeping changes to how corporations, pass-throughs, and individuals are taxed. One fairly innocuous provision that was included in the bill may have quite significant implications for certain taxpayers, and that's the changes that were made to 451. Let's start by talking about 451B, which, as I said, is pretty innocuous. All it does is change the all events test, such that for income tax purposes, a company has to recognize income no later when that income is taken into account as revenue for financial accounting purposes. And that doesn't sound very significant. And in fact, the language in the statute isn't very significant, but the consequences are. Many companies are finding that it's requiring them to recognize income much more quickly than they had been recognizing that income for all events purposes. In fact, one financial institution has recently reported that their revenue is going to go up by almost $2 billion this year as a result of the change to the 451 statute.
What's important to also remind ourselves of is that the new 451B code section does not change the income realization event for taxpayers. It merely affects the timing of the related income recognition.
That's right. So it's not a whether question, it's only a when question. That is when they take the income into account. Importantly, there's one significant exception, and that's with respect to special methods of accounting. The conference report mentions several that are included within that definition, the installment method or taxpayers that use Code Section 460. What's going to be interesting in the guidance process is how the service interprets special methods of accounting. For example, are all insurance methods special methods of accounting?
In addition to the changes to Section 451B, the new Tax Cuts and Jobs Act also revises and adds to the code Section 451C, which is a codification of the deferral method provided underneath Revenue Procedure 2004-34. This election allows taxpayers to defer the treatment of advance payments for income recognition purposes up to 1 year after the receipt of such income, provided that such income is also deferred for financial accounting purposes. What's important to note is that the codification of the deferral method in 451C also excludes from the definition of advance payments rent, insurance premiums, certain payments with respect to financial instruments, the same exclusions that were also provided in the revenue procedure.
But for any company that's seeking to defer revenue under now 451C, it'll be important that they check those exceptions.
What's important underneath both 451B and 451C is that with the combined effective date of the new revenue recognition standards for financial accounting purposes, ASC 606, taxpayers have to address both their financial and tax reporting standards in light of this new regulatory body.
Right, and so a company that may have to accelerate income for financial reporting purposes may find that a deferral that was previously available is no longer available to them. Additionally, they may find limited deferrals because of the effective repeal of 1.451-5, which was previously available to defer income associated with the sale of goods. Another more important provision that's going to be affected by this enactment is 1.451-4.
And Treasury Regulation 1.451-4 historically provided not a deferral of income, but an exception to economic performance rules, allowing an accelerated estimated cost of goods sold deduction for taxpayers issuing certain coupons. And in this day and age, loyalty programs, many of the customer programs that companies have today, will be greatly affected by not only the new Tax Reform Act, but the implementation of ASC 606 and whether they implicitly repeal or eliminate the benefit that 1.451-4 historically has provided.
That's right. An important issue that will have to be addressed in guidance is the continuing effect of 1.451-4, which we hope the service will continue to keep in effect.
Thank you for viewing this video on the effects of tax reform on income recognition. For more videos on tax reform and other bottom line videos, please visit our website at eversheds-sutherland.com. Thank you.